Well, Best Buy shares are in rally mode this morning after surprising Wall Street with an earnings beat and maintaining their profit outlook. Let's dive into this with Michael Lasser, UBS senior research analyst who covers hardlines, broadlines, food, and retail. Michael, let me get back to that question we were talking about earlier today on Best Buy. They did cut their forecast going into the quarter over the summer. So how much of the pop we're seeing today you think is really just kind of a bit of a relief coming through with low expectations?
I think it is a bit of relief coming through with low expectations, in part because the company had guided to very conservative outlook for the year ahead. The outlook from here remains highly uncertain. It's going to be a late and highly promotional holiday season. Best Buy noted that their sales in October were down 15% year over year, and that's continued into the first part of November. So the key now is, what's the outlook for 2023? And can we really take what has happened recently and extend it out into the next year? And it remains to be seen. So Best Buy is responding well today, but we expect the stock to be range bound as this uncertainty weighs on the outlook for at least the near term.
Yeah, listening to what we heard from CEO Corey Berry on the back of these results, obviously declines in products across the board, but the biggest declines being seen here on computing, home theater as well. I mean, is there anything when you look across the product offerings that Best Buy has that you think can provide some support when you consider that uncertain macro environment?
There are some products that will provide support. They talked about gaming, augmented reality, outdoor furniture are all doing well, although they're in a nascent stage. They have a healthcare business that should help over the long run. For example, they just rolled out hearing aids to 300 stores. The key is the business right now continues to be driven by computers, TVs, and mobile phones, and at least two of those categories were purchased heavily by consumers over the last few years to do things at home, like watch Yahoo TV. So now some of that excess is being worked off, and that's resulting in difficult product trends, and that's going to really dominate the outlook for Best Buy for the near term.
Another stock that's getting a big pop today is Dick's Sporting Goods. And on that front, you say that they are supported by a pretty resilient core customer right now. You've got a 12-month price target of $120 a share. So we're sort of close to that range there. What do you expect to be the catalyst? And are there maybe, when you compare it to somebody like a Best Buy, are they not likely to see as many significant headwinds given that strength in the core customer?
So what you're seeing in the difference between Best Buy and Dick's Sporting Goods is really a tale of two categories. As I mentioned, areas like computing and TV are not doing as well because the consumer binged on the consumption of those goods over the last couple of years. On the other hand, there are really good trends in areas like footwear and athletic apparel. There's a lot of hot products from key vendors like Nike and Hoka and Hey Dude. And Dick's is at the intersection of all that goodness right now. It's got fantastic content, and its same-store sales are benefiting from that. On the other hand, it has some excess inventory that it's looking to clear through, and that's weighing on its margins. The good news is that these trends, because of the casualization of the consumer, should continue. Demand should remain strong, even if there is a weaker macro environment. And in theory, they'll come out of this year in a cleaner inventory position, which will put less pressure on the margins. And so that's what we're looking for as they come through the fourth quarter.
UBS senior research analyst Michael Lasser, good to talk to you today. Appreciate you stopping by.